The U.S. economy added 130,000 jobs in January for a strong report, beating expectations, but revisions could eat into the gains. And Andrew Szczurowski, Strategic Income Portfolio Manager, Morgan Stanley Investment Management, joins us now to talk about this. Thanks for your time.
Thanks for having me.
How likely is this to be revised down, and by how much?
If you look at history as a kind of roadmap for what will happen, it's very likely to be revised lower. It's something we've seen over the past 2 years pretty consistently. As your last guest was talking about, we just had these annual revisions that showed that all of a sudden 2025 had essentially 840,000 less jobs added than we expected. And what that ended up meaning was that we were only averaging basically 15,000 job gains per month. So the 130,000 job gains we have today has to be taken with a little bit of a grain of salt. It'd be great if this was the sign of a new trend. I just don't think it's likely to be the case. And I think that as we see revisions come out over the next 2 months, they're going to be lower, and we could pour some cold water on this hot number today.
Why are we seeing these kinds of revisions that are really large for the job numbers?
Yeah, look, one of the main reasons is that the survey response rate. So when the BLS goes out and sends these surveys out to different companies and households, the response rate, so the amount of people actually responding to them, is much lower than it was pre-COVID. And so over time, some of those responses come in a little delayed. But the other part of it is that essentially they're extrapolating what the missing 50% or so might actually have said. And so I think because of that, the data we're getting, the standard deviations, the standard errors on this data is much higher than it's historically been. And so it's one of these things that it's nothing that the BLS is doing incorrect. It's just a problem of kind of data collection that's changed over the last 5-6 years.
Okay, so based on what we've seen from the revision of last year and based on what you've seen from January, how would you characterize the American labor market right now?
Look, I'd say every other labor metric we look at outside of today's report is showing a cooling labor market, and a labor market that's getting close to stall speed. So if you look at the number of job openings, we had this job openings number come out last week. Over the past 2 months, for the first time since pre-pandemic, we've now seen less job openings than people unemployed. If you look at other kind of alternative data providers for the labor market, they're showing weak to negative to flat job gains. And so the other thing we're seeing is that when someone loses a job, they're staying unemployed longer and longer. So these are all concerning signs. And this is a reason why we think that while inflation's running a little above what the Fed would like in order to cut rates, the labor market will eventually allow the Fed to kind of resume rate cuts as we progress through the year.
Okay, so does the Fed do its own revising of numbers, knowing the numbers are likely overstated?
The Fed certainly was aware that these numbers were going to come in and there was going to be downward revisions. So I think they definitely take that into account. Now, do they do their own revisions? I think that what they're looking for is to see, is there some sort of change in trend in job growth? And right now, and then if there is some sort of change in trend, is it something they can help with in kind of short order? Is it something that's going to cause inflation? If all of a sudden, if we see job gains resuming, then the Fed all of a sudden has to worry about kind of wage inflation again. But I don't think that's going to be the case. I think all these different signals we're seeing, and then you compound that with kind of artificial intelligence and productivity gains on top of that, I think is going to allow the Fed to, by the end of this year, solely focus on the labor market and not on inflation.
What about the fact that most of the job growth comes in healthcare? Does that concern you, or is that an added layer of concern?
No, it certainly concerns me. I think when you look at the number of companies, look, most people in the United States aren't employed by publicly traded companies, but there are a significant amount that are. And so when you look at publicly traded companies, a lot of these companies are, you look at what Amazon or Walmart or others come out and say is that essentially they're not expecting to hire over the next couple of years. But as your prior guest pointed out, the healthcare sector, we have aging demographics. This is something that we require more and more healthcare for those aging demographics. And it's something that, at some point you'd love to see this kind of, depth, breadth spread out. You'd love to see those job gains spread to other sectors, but it just hasn't been the case for the last couple of years. And then you compound it for the fact that the government sector, both federal and at the local level, you're starting to see job declines there, and it's even more concerning. So I think for a couple of years coming out of the pandemic, we had this boom in government jobs, but that's starting to dissipate, and you're seeing that go the other way.
Okay, can you factor in AI for me? You touched on it. I'm wondering what you foresee for the year as far as AI improving in some of the financial institutions, for example, some of the tech stocks, and perhaps leading to job losses there.
Yeah, I think what we're seeing now is we're in the early stages. I think right now a lot of companies are experimenting with AI, figuring out how it can kind of supplement and be a kind of co-pilot in their work. As time progresses and more kind of agents are deployed, we expect that to kind of expand into how can it replace certain jobs. And so I think today, right now, you're not seeing a huge impact. You're seeing it kind of add to this productivity gains. But I expect over time, what you're going to see is that companies that would traditionally be hiring are just going to keep their employment stable. And I think that's the thing that we've seen. If you look at what growth was in 25, GDP growth in the United States was very strong. We had GDP growth close to 3% in 2025. But we had, as I just mentioned, only 15,000 job gains per month. And so I expect that to get even worse in 26 as more people actually start to really deploy AI and move from experimentation phase into implementation phase.
All right, Andrew, I'm going to leave it there. Andrew Szczurowski is a strategic income portfolio manager, Morgan Stanley.